Hello everyone, welcome back to Corporate Decoder. Today we're diving into the world of Windtree Therapeutics, but be warned, this report is less a gentle breeze and more like a dust devil of financial uncertainty. Get ready for a bumpy ride. This small biotech company just released its quarterly report, and it's raising some serious questions about its future. We're talking about potential money troubles, strategy shifts, and race against the clock to stay afloat. In this video, we will explore what's really going on. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these reports live with fellow viewers. Windtree filed their quarterly report called a 10Q with the Securities and Exchange Commission, or SEC. It's basically a financial update. What does it show? This company trades on the Nasdaq capital market under the ticker symbol WINT. It's important to remember this is the capital market, not the normal one, which usually means less trading and lower stock prices. As of mid-May, they had about 3.7 million shares outstanding, which for a public company is not that much. The report has a warning about forward-looking statements. It's a reminder that the future is unpredictable. The company lists potential problems like needing more money, clinical trial delays, and competition. These are important to keep in mind when assessing the company. Let's jump into the numbers, starting with a quick look at their balance sheet. It's like a snapshot of what the company owns and owes. Their cash is down. They started the year with about $1.8 million, but by the end of March, they only had $1.2 million. This means they burned through about $600,000 in just 3 months. That's not a good sign when you are talking about small biotechs with razor-thin cash reserves. They also have a big chunk of their assets tied up in intangible assets, around $24 million. These are things like the potential value of their drug patents. If these drugs don't pan out, these assets could be worth a lot less, which could hurt the company's financial standing and result in further share dilution or bankruptcies. Now let's flip over to what they owe. Accounts payable have risen significantly from $1.9 million at the end of the last year to over $3.1 million. This means they are falling behind on their bills and might have to choose which bills to pay. They have a bit of financial maneuvering with something called Series C redeemable preferred stock. It dropped from $3.2 million to about $1 million. This is money that could potentially disappear depending on certain conditions being met. It may or may not be good to see it drop. Now let's look at the income statement. This tells us how much money they are making and spending. Their research and development costs are roughly the same, around $2.2 million for both the quarter in review and the same period in the prior year. This could be a sign that they are trying to preserve cash. General and administrative costs decreased, which is a bit of a positive, from $2.1 to $8 million. Cutting back on administrative costs can help them weather some uncertainty. The company has a $134,000 loss because of their warrants. These are options for people to buy the stock and are basically a bet on how well they will perform. The net result is a loss of $4 million, but it is better than it sounds. The previous year, the same quarter, was at about $10 million in gains. This is because the previous year they had a very, very large gain on debt extinguishment, which means the company cleared a lot of debt, but this time there wasn't an event. They had to pay almost $1 million in dividends to their Series C preferred stock. This will keep happening and it adds up. Ultimately, at the end of the day, they had a loss attributable to common stockholders of $5 million versus $10 million profit the previous year. Let's get to their cash flow statements. This shows how money is moving in and out of the company. They burned through over $4 million in operating activities. This means they're spending a lot of money to keep the lights on. This is better, however. The prior year was $9 million. They managed to bring in $1.8 million through financing activities. This is cash from sales of stock or debt. As the business is burning cash, they can only finance it with dilution. This means existing investors get a smaller piece of the pie and the stock value may be affected. Their cash pile decreased to $1.2 million from $1.8 million last year. In some supplementary information, there was an extinguishment of warrants and whatnot. This report, while small, could make a whole video on its own, so we will just gloss over it. A critical point in the notes to the financial statements is that there has been a 1-for-50 reverse split of their stock. So if you are comparing the share price of this company, you might be comparing apples and oranges. Reverse splits are often done when a company's stock is really low, so they do a reverse split to artificially pump the price up. Sometimes it works, sometimes it doesn't. Now let's talk about the most concerning part, going concern. The report indicates substantial doubt about Windtree's ability to continue operating for the next year. They don't have enough cash to last, and they need to find more money. This should raise some concerns for any investor. The company says they are trying to get more money through stock sales, debt, or finding a partner, but there is no guarantee. If they can't get more funding, they might have to scale back or even shut down operations. Keep in mind that the entire report is based on some estimates and assumptions, which is quite normal. The senior secured notes also went up the same amount. Essentially, they paid for a debt with a debt, but it all cost a lot of money in the process. It's like rearranging the deck chairs on the Titanic. The real kicker, the auditors included what's known as a going concern warning. What does that mean in normal English? This means that because of their current financial situation, their auditors are indicating they may not be able to operate their business for the coming 12 months. The management's plan involves finding capital to alleviate going concern issues. However, there can be no assurances that there are adequate funding on terms acceptable. The company then says these conditions raise substantial doubt about our ability to continue as a going concern. In other words, they might not be able to continue operating. That is the most serious part of the report, and you should keep that in mind. Now, looking at these numbers more broadly, the biggest challenge facing Windtree is their extremely tight cash position. While the company points to promising research and potential partnerships, they need to secure funding very soon. The core operations are solid, but the big question is if they can raise money on favourable terms. What does this all boil down to? Windtree has a promising pipeline, but their financial health is precarious. The company needs a serious cash infusion to continue and avoid more dilution of existing shareholders. The management seems to have a plan, but it depends a lot on outside events, whether they can raise money or whether they can form lucrative partnerships. It's all speculative and not very concrete. It is high risk. Alright, that's our breakdown of Windtree's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out the Discord in the description. It's an amazing spot to further talk about these topics. Thanks for watching. See you next time.